Right now we're going to start with Osisko. Joseph de la Plante is going to give a presentation on Osisko, and that's going to be followed by Barkerville, and Chris is going to be giving the presentation from Barkerville. So start with Joe. Come on up. Thanks so much.
All right, thanks everyone for sticking around for the presentation. I'll walk you through Osisko Gold Royalties. Sort of talked a bit about it in the earlier presentation. We think it merits a closer look if you're not already familiar with the story. So we're a bit of a different beast in the royalty space. Osisko is a growth royalty company. That's quite different from some of our larger peers who are more sort of yield plays with not a lot of growth embedded into the portfolios. This company was created in 2014 when we sold our previous company, Osisko Mining Corp, to Yamana and Agnico Eagle. And as part of that transaction, we spun out 5% NSR. We also had $150 million of cash and essentially a small investment portfolio. 5 years later, we are a $2.5 billion royalty company. We've grown the royalty portfolio to over 135 royalties, 20 of which are currently producing. We are listed on the TSX and the New York Stock Exchange, and we do pay a dividend, which currently yields about 1.5%. What differentiates this company in our portfolio is really our jurisdictional focus on Canada. When we started this company, we had gone through this experience of discovering and building and operating a great mine in the best jurisdiction in the world. And that whole team stayed with us in the royalty company. And we wanted to leverage all of those relationships in this jurisdiction to create value for our shareholders. We're also conscious of the fact that the royalty business is very competitive and there's a lot of players and it's fairly crowded. And we knew that we weren't going to be able to show up and compete without bringing something different to the space. So I'll talk a bit about our business and why it's different later, but if you look at just this page here, you see we have 104 assets in Canada. Our cornerstone assets are Canadian Malartic. We have a royalty on the El Yerno mine, which is now owned by Newmont. We have a diamond stream on the Renard mine and a silver stream on Mantos Blancos, which is privately owned. The way we think of our business is really similar and analogous to real estate. So not only are we chasing after good projects, but we're also focusing on mining camps. And where there's a long history of production, we're trying to accumulate royalties in those areas and cover as much as possible, cover those camps. So where we sit today, we have about 25,000 square kilometers of royalty coverage in Canada alone. So that's probably one of the largest, probably the largest royalty package in Canada. In terms of our production, we've had steady growth since we started the company in 2014. Last year, we produced just over 80,000 ounces at 89.5% cash operating margin. This year, we have more growth planned with guidance of 85,000 to 95,000 gold equivalent ounces at a margin of 88%. And this is really the interesting thing about royalty companies is the margins. And when you look at our operating cash flow, that is our free cash flow. There's no capex per se. There's no additional commitments to these investments. Once we make these investments, they're fully funded, and we can, use our free cash flow to reinvest into new assets. This is just a depiction of all the different royalties that we own and their contribution to our portfolio in 2018. I think the message here is, we currently have 20 different producing assets. It's really amazing to be able to achieve this level of diversification within a company that has only 25 employees. If this was a producing company, we'd probably have 1,000 employees to be able to manage all these assets. So, there's a lot of value in being able to build such a large portfolio with such a small team. Our cornerstone asset is Canadian Malartic. This is a great mine. It's the mine that our team built, produced just under 700,000 ounces last year. Some of its best years are still ahead of it. It's on track to be producing over 700,000 ounces for the years to come. So a very, very great royalty to have in our portfolio. Similarly, we've delivered strong operating cash flow since 2015, and that's forecasted to grow in the years to come. So what's really different about our business is, as I mentioned previously, when we started the company, what we decided to do was to use our technical experience to our benefit and to drive value for our shareholders through that team. And so the way that we invest into the sector is we try and find opportunities early on and invest in a hybrid of royalties and equities. So this, towards the left-hand side of the page. The page here shows the typical value cycle of a mining company. Most of you have likely seen this curve before. And we try to find value within that curve by investing either early on the exploration side of these projects and securing rights later on for project financing, or we invest in the middle part of this curve, once the studies have been published and the economics are known, and really what we're solving for at that point in time is a financing problem. So we look for value in the sector. We take risks differently than the other royalty companies that way. And we really are trying to position our company to avoid having to compete against the big royalty companies. That is an important part of our business. Here you can see how our business is structured. So at the top you have Osisko Gold Royalties. We're $2.5 billion market cap, 25 employees, a big technical team. And the way we've built out the business is we found projects that we liked and either funded or started companies to host those projects and continue to develop them with financial support from Osisko Gold Royalties and by sharing the technical expertise that we have. The 5 companies on this page are the 5 more prominent of our accelerator companies that we have in the portfolio. Following my presentation, Chris Lodder, CEO of Barkerville, is going to present Barkerville Gold Mines, which is one of our important investments. But the model is fairly simple. We take a royalty early on, we take a cornerstone shareholding, we fund every single one of these companies' financings, we place a lead order, and we try to help those companies attract capital from the market. And our goal is for every dollar that we put in, they can draw $10 from the market. In terms of our growth profile, we do have a significant amount of growth coming in the next 5 years. A lot of these projects are royalties that we've either structured ourselves or acquired through M&A transactions that we've done over the past 5 years. Some key projects that are going to be coming online for us in the next little while. Number 1 would be the Eagle project in Yukon, which is owned by Victoria Gold. That one's scheduled to produce in the second half of this year. And once up and running, it'll be contributing about 10,000 gold equivalent ounces to our production profile. We also have a currently producing stream on the Mantos Blancos mine, but they're going through a sulfide expansion, which will not only double the throughput, but the silver grade in those sulfides is double what it is in the oxides, and so we're going to get a great lift from that stream as well. We do expect the Canadian Malartic Partnership to eventually put the Odyssey zone, which is a zone adjacent to Canadian Malartic, into production. This is a zone that we discovered when we were operating the mine. It's a roughly 2 gram per ton underground extension of Canadian Malartic, and that is one of their prominent projects right now. So the short of it is that there's a lot of different projects that are going to come online in the next few years. We don't know the exact timing of any of these projects. However, we have no additional capital investment to make, and we'll benefit from any growth coming from any of these projects coming online. Just skip forward. I've made the point already, but it's always good to see it on paper. If you compare our portfolio to that of our peers, about over 80% of our NAV is coming from North American assets, and 70% is coming from Canadian assets. Contrast that to the rest of the royalty sector. It's quite a unique portfolio in that sense. And as we see, in the royalty space, what we've found is that it's becoming harder and harder to find good opportunities unless you structure them yourselves. And the last two big royalty deals that we've seen have been in Botswana and Colombia. And we're trying to stay disciplined and keep investing in Canada, keep investing in the US and good, safe jurisdictions. We think that eventually will get us a premium for our stock. Just a quick snapshot of our valuation multiple. We're trading at a modest discount to our peers. We are building a business that is different than the rest of the royalty sector. We have been working towards proving that concept. We think that when some of our key accelerator investments begin to produce is when we will benefit from the higher multiples that our peers see. But these things are not earned overnight. And so, dedication to the strategy is how we feel that will deliver value for our shareholders. Perhaps in the same line that we talked about previously in the last discussion, if you look at who owns Osisko today, our largest shareholder is a private equity fund, and our second largest shareholder is a pension fund. These are different pools of capital looking for long-term exposure to the precious metal space. They're great partners. Every time we've made a major acquisition, they've co-invested with us, either by providing equity capital or investing alongside us. And that's a key part of our strategy, is keeping those financial partners close to us, because the royalty business is all about capital. It's all about having availability to capital when you need it. In terms of returning capital to shareholders, we do have a steady dividend that we've been paying since we started the company. Our goal is to increase it as we have new cash flowing projects that come online. So far, we've returned 94 million to our shareholders in dividends in the past 5 years. And over the last year, we were aggressive in terms of buying back our own shares. So in total, between share buybacks and dividends, we've returned just shy of 140 million dollars to our shareholders. Our balance sheet is clean. We finished the quarter with 110 million dollars, and we have a credit facility of 450 million dollars that is undrawn, that we can draw on for acquisitions. And on top of that, we have an equity portfolio worth over 400 million dollars, which we can draw liquidity from if we need it. So we feel we're in a great position to continue making investments as they present themselves. So in summary, it's a very different business. We feel the best years are ahead for Osisko Gold Royalties. We're going to produce this year, 85 to 95,000 GEOs, good dividend yield, different business overall with low exposure to geopolitical risk. So we would encourage you to have a closer look at it, and I'll be available for the rest of the day to meet with anyone that wants to learn more about the company. So at this point in time, I'll hand it over to Chris Lodder, CEO of Barkerville, who will walk you through Barkerville Gold Mines, which is one of our big investments.
Good afternoon, everybody. Thanks for being here for this presentation. Joe's done a pretty good introduction of the group. I come from the Osisko group originally too. Just a little history on this. First of all, a typical forward-looking statement. A little history and overview of the project. It's located in British Columbia, south central British Columbia. It covers about 2,000 square kilometers of mineral rights. Covers pretty well the entirety of the old Caribou gold fields, which was the third largest alluvial gold rush in North America after the California and the Klondike and in between in time. And it was also, for about 40 years, an underground producer from mid-1930s till the late 1960s. It's produced about 4.5 million ounces of gold total there. We presently have a resource, an underground resource of 3.7 million ounces, and it's growing. We'll be putting on a new resource in a couple of weeks again. And we're looking at a phased approach to grow this thing through production, starting next year at about 35,000, going to about 135,000, then in 2022, and then to about 215,000 in 2025. The mineralization is gold-rich veins and replacements. It's an orogenic system. There's very little magmatic component, if any, in this. We don't find any at all. It's very straightforward metallurgically. There's not refractory. Typical recoveries from our mining and previous mining has been around 92 to 94%. And the area is located in a place in British Columbia where we're not out in the middle of, a remote area. It's fairly accessible, yet there's low population. It's an industrial area. It's logging and mining in the area. We have strong First Nations and community support there. We do have a mill, a permitted mill and tailings facility just to the south of us on the QR block, located down in this area here, where we presently we produced ore last year, and we'll go next year and start producing there again. But it comes from this main area right in here. The company was, when we inherited this thing, it was really an opportunity that arose after we did various studies around Canada looking for camps. This one here we looked at, but because it had a lot of legacy issues, mainly incredibly overinflated resource statements and so on, numbers like 60 million ounces and so on. That was suspended from trading for a few years. There was all sorts of lawsuits involved with it and so on. And so most people, including ourselves, we didn't really want to touch it. The opportunity arose when Mr. Eric Sprott wound up owning the majority of the company due to a gold loan he had given to the original management that converted to equity. That allowed, he then invited us to look at co-investing in it. That was the time we decided to take a look at it. So I went over the due diligence team with Osisko, and we took a look at it, and I left there basically lukewarm. I went, I'm not sure about this thing. Lots of gold, but didn't really understand it, But we sat down, looked at the data a little more, said, okay, probably worth taking a punt on. So we decided to put $5 million into it in mid-2015, bought about 20% of the company, and I went on as nominee director for Osisko, and we had technical oversight on data compilation and so on, trying to understand basically, is it worth it to invest anymore or not here, So we gave ourselves a 6-month sort of time frame to try to see if we want to continue or not. So after about 6 months, it got warm on it. I wouldn't say it got hot on any means, but warm on it. But we realized there's a lot of gold there. We still didn't understand the controls of mineralization. We were happy with the jurisdiction. We did a lot of understanding of the liabilities we're walking into. That means legal due to the false resource statements, as well as environmental because of the old mining camp there, and so on. And basically said that's manageable. We can deal with that. And we came up with a game plan in terms of exploring it or testing it in terms of mineralization potential, and with an idea to go to develop a business plan for it. That required $35 million though. So I went back to the board, the management team, and I said, guys, if we're going to do this, we're going to have to invest a bit of money here. We can do it quick, no use waiting, we can get it done in a year, but we have to make a decision. So our next decision point was really getting in there and understanding the controls of mineralization, understanding the potential, and how we would go forward in developing this thing. It would still be pre-resource in terms of compliant, but it would give us an idea. So we walked in there with about a dozen drills. I gave a mandate to the exploration group there to go ahead and gave them a $10 million budget. I said, go and do it. I don't need news releases. Get out there, find out what's going on, get underground, drill, what do you have to do, and let us know, if this thing's worth it or not. So basically, they went underground in all the old mines, about 15 kilometers of sampling and mapping underground, drilled a couple hundred holes, and we came up with a model basically that allowed us to have some predictability in this. So we said, okay, let's start testing that model. Prior to us having that model, we were about 1 in every 10 holes was hitting anything of significance. And what came out of that was about 100% hit rate. I'm not lying, 100% hit rate. It's amazing. So I went, wow, okay, this is working. Okay, that's because we knew where to drill. We started getting an idea now what's controlling the mineralization, and we simplified what was before a very complex mineralization model and a geology model, and we got it so that it became something we can predict and therefore be more efficient with the drilling. Did that make it any easier? Not really. We still had to drill the crap out of this thing. It still was costing us $20 million for every million ounces of drilling because it's veins. It's veins and it's underground. Now, in the meantime, we were looking at the potential of the open pits that we inherited. There was an open pit resource of about 4.8 million ounces at 2.4 grams. That SRK did, I think, in 2014 or 13. That was kind of the final resource after all the scams. And we wrote that off. We saw that was completely not there. We said, no, they were modeling it with a type of statistical modeling called that left basically us to look at deposits that are more related to porphyries or more homogeneous type deposits, and we threw that out. So we wrote that down to 0, and we started working on our own resource. So that was a model there that we developed, and it's simplified, and it's related to 2 key factors. One is the sandstone units are what host the mineralization, upper part being more calcareous, lower part being less calcareous. And that rock, it folds in a late folding event. It was folded and it created what we call axioplanar veins. I won't get into that. All it means is we got vertical now vein corridors. We get multiple veins inside a vertical zone that we can look at as a planar type ore body that we can drill off in a planar zone. There are other mineralization there, low angle, very high grade. Some of it was a principal ore when Newmont mined here from the 30s to 58. That was their principal ore. But because of the attitude of that being at a low angle and rod-like, we decided not to put that because it's too hard to drill from surface drilling. So we left that out. We only looked at the vein systems and the vertical, these vertical vein corridors. The resource that we put out last year was approximately, the global resource was about 3.7 million ounces at approximately 5.8 grams, combined about 6.1 grams in the measured and indicated. This shows the core part of the district. And what you see there is the main resource, or 95% of it is in Island and Cow Mountain, so right in these areas here. And that's down to an average depth of about 250 to 300 meters, so very shallow. We do have drilling down to 800 meters below these things, and quite a bit of drilling to 600 to 800 meters that shows that continuity at depth. The question is cost, to drill that off at cost from surface. So we do, this year, most of our drilling is actually looking at that area in there and filling in some of the data points. So we do have hundreds of holes there, plus we have some old underground there. Another thing on the underground in our resource, we've completely excluded that out of there, the old workings, and a 7-meter buffer around all those old workings are not included. You lose about 900,000 ounces. The reason we did that is for our internal feasibility that we just finished doing last year, for the permitting process we're going now through to get a larger mine going, is because the permitting requires a lot more work to deal with the old mines. We will go back and take them out after. We're going to backfill it and so on, but it's just too much work right now to mess with our permitting process. So the area, the project sits right in here. That's where it sits. The town of Wells, about 250 people, is where we work out of there. It's the town built by Fred Wells, who put the first mine there in 1933. In this area, there was Caribou Gold Quartz, and Newmont was mining here about a year later on Island Mountain Mine. So this mine here, Mosquito Creek, was in the 1980s. So those 3 mines produced about 1.3 million ounces down to a depth of about 200 meters. They're very shallow. Grades were between 0.4 and 0.6 ounce to the ton. That was being mined there, but they were mining individual veins. Individual veins was, yes, they could do it then. We cannot get miners to go and mine those types of veins anymore. So our model was, just going back, sorry. Our model takes into account this figure right down here. Basically, what they did before was they went in, they mined the white, which is the veins, or individually, and left the black behind. Basically, white is where the grade is, black, there's nothing there. What we're doing is we looked at where you get the density of veining, these vein corridors that you see there highlighted in red, the darker ones, and we're taking it all. So the average width of that is about 4.5 meters wide, but the grade is diluted down now to 5 to 7 grams, okay? So that's your diluted grade in those corridors, eh? But we can get people to mine it, we can get a big equipment underground, and we can mine it with a lot more tons per and ounces per vertical meter, eh? Safer, and it's more efficient. And the extension, the depth now that we're drilling, I mentioned here in this slide, is down that yellow zone. So you can just sort of figure out that because we do have it continuing down. We got drill points down to those areas there, but not enough to call it a resource. For us to call it an inferred resource, we have to be less than 50 meters. And to call it a indicated, it has to be, drill holes has to be close to 25 meters apart, eh? And in some areas 12.5 meters. There is variability, obviously, in the individual veins, a lot of variability, grades all over. That's why we look at this bigger model of taking everything, including the low grade between the veins. That black I mentioned zero, it isn't really zero. There is grade with it, eh? And there's lots of little veins in there. But from a historical mining point of view, it was considered zero, okay? So we do get some benefit from that. But generally from the way we're looking at it is we're taking out all the zones there. They're all vertical, these things do, so it's all long hole, very simple. The strike length of that sandstone package is about 300 meters on average. It dips at 70 degrees to the north. We don't know the depth of it. They say we got down to 830 meters, our deepest drill hole vertically, and we're still hitting it, eh? So we know it keeps going. So that's a good news for us. And the actual width of the thing that I mentioned, they go down. The narrowest we've done is 2.5, but the majority are 4.5 to 5 meters. There are zones where it's 20 meters. We've left 5 meters between each vein corridor for support reasons too, eh, when you're mining. So this has not just been a geology. We've had mining engineers involved from the Osisko group and this right from the beginning, looking at, okay, that's fine, guys, but how are you going to mine it? And that's what led to this model. So it's not just a pure geological model, it's also a mining model. Go through that, sorry. This is some of the newer drilling we're doing right now, just to show that we started drilling not just below it, but on strike. So 2.5 kilometers away from the main resource, we have a zone up on top of Barkerville Mountain where we have our present mine permit, where we're going to be starting mining again. We won't start actually pouring gold till January next year, but start the development again right now. This is the new area we found that was known about somewhat, but we didn't understand it. We had to, until we got the model. And then we started drilling that this year again, because the last time we did some testing up there was in 2015, before we had the model. So we were drilling the wrong way. So now we start hitting this and we realize there's a whole nother system that has dense veining, just like we've seen on Island Mountain and Cow Mountain right up here. And it's within 400 meters of our existing mine. So this is a pretty exciting thing. It just came out in basically between March and April this year. A lot more drilling to do yet. Like, these things are drill intensive. Just want people to understand that. We did some mining last year. We went underground. We said, okay, let's not only, we had a permit, let's use it. Let's get data we need for the feasibility work and PEA work we were doing. And let's take that thing. So we mined 150,000 tons in 2018. And produced about 24,000 ounces of gold, I think it was. And we got to test all sorts of new equipment. We had our own ore sorter there, so around 33,000 tons of that, to see how that would do for making a concentrate. We used different mining equipment. We used a road header for development as opposed to just jumbo, drill and blast. Different types of water treatment, rock mechanics, looking at support, how we go through the different rock types, what we're going to need in that. So it was real data. It wasn't just a 10,000 ton test. It was 8 months of mining, 150,000 tons. So this is real data we got from this. So that led us to the next thing we're doing. We said, okay, what do we see here? What do we do next? How do we grow this thing? How do we get it paying for us now to the next level? We're not there for the present mine. We're doing the 35,000 ounces a year. That's not what we're there for, okay? What we're there for is a bigger project. So we looked at this thing and said, okay, we've done all this work on a feasibility that would get us to the first permit using our existing mill, but it requires us doing a concentrate on site because our mill's 110 kilometers away. So it cost me $30 a ton to truck it there. So we designed it to put a concentrate on site, and we're hauling to the mill and using it for the first couple of years. Why? Because it's permitted and I don't have to get a new mill permitted in a tailings facility. So that's what we're doing right now. So that's about a $200 million investment Canadian to move it to 135,000 ounces a year. And that gives us, if we mine at that rate, that'd give us about 20 years of mining. But the reality is what we're doing then, within 3 to 4 years after that, we will be permitting, or have permitted a new mill on site that allows us to move it to about 215,000 ounces a year. So that's where we were going. Beyond that, there's a bunch of other, obviously, upside just because of the length of the district. The other thing I'm not really showing here very well, I think I've got one slide here, but it's showing the district is 67 kilometers long. There's a beginning and end to this. It's related to where you are in the Earth's crust and what's preserved and what's not. Along that trend, we have 160 other targets. There are some that we've got some drill holes into now, but most we haven't even touched. And they all are we're seeing very similar. I'm not going to say they're as dense as what we see here, but there's enough definitely to support other operations on the trend. So this is why we're there. We saw this as a 30-year plus district. We saw it as something we could scale up, reasonable capex numbers, and see a good margin on the thing. So just somebody said, I think it was asked about what a royalty does. So yes, we have a 4% royalty. So far into this project, there's been $240 million raised. Okay, so we're trading below what we put into it. 40 million of it went to buy Eric's brought out. We had an option to buy that from the beginning when we got involved with this. And then we had a 4% royalty on it now, which they paid $60 million for Osisko, so it's paid up. And what does that do in terms of the actual margin? It's about at $1,500 Canadian gold. So at about 1150, 1175 Canadian or US, it's affected it by about 13%, 12% the margin. That's what 4% royalty does on it. But
so you say a 4% royalty,
yeah,
is going to impact your gross margin
about 13 to 14%.
by 14%.
Yeah. So the other, no. So that's, I heard that number. I was going, no, that might be in some cases. If you're at a 4 gram or 3.5 gram ore body, maybe under, you might have that, like some of the mines in the Timmins camp. But you're not going to have that here.
What's been your cost of buying a reserve?
Oh, it's what, $17 for reserves. Resource, measured, indicated, and inferred combined, it's around $17. Reserves, to convert to reserves, you put all the engineering and so on. I mean, it'll go down because after you got your permits, because to this date, it's about $42 Canadian. That's kind of, the rest of the stuff is just blah, blah, blah. Yeah, and then the team is the directorship. You can see here, Sean is their chairman. Tony McCouche from Kirkland Lake is the director. He's on the technical advisory committee too. John just resigned because he's on too many boards, and Glass Lewis is all over him. So Blair's replaced him, and then myself, Tommy Obradovich, and some other people. The management team is generally the Osisko team, the executive team here. So that's it there in a nutshell.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?